Good morning, guys. This side Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting, and also a venture capitalist. As usual, we are meeting at 3:30 a.m. in the morning when half of the globe is sleeping, and we are shooting a video. There are three kind of people we have in this globe. One who is walking on the road and feeling that whatever is happening in these big buildings known as banks, financial institutions, hedge funds, prop desk and all, it is good. One who is actually working in these buildings in the back office department, and throughout the life they never got to know that what exactly is happening in these buildings. And third, who are working in the department which is technically known as structuring department, a department who structure the products. And if I speak from our parlance, then they are known as structurers. A structurer is a person who structured the derivative products, who create it actually. And the prominent is always Goldman, JP and all. Indian banks never be structured because they do not know the meaning of derivative. That is a hard reality. In March 2014, Yes Bank scandal happened. None of the credit rating agencies, even few days before the default, warned the investors, and end result we all knew. In the last 2 weeks, I have saw several comments about 81, additional tier 1 bond of Yes Bank in the public domain, and even today, the media is reporting about 81 of various other banks. But are we bothered? No, we are definitely not bothered. There is one more industry which is parallelly running, and unfortunately this industry is now losing momentum, and that too at the fastest pace. And I never fear or always dare to say this, that the level of innovation in this industry is now zero. In fact, let me tell in a very right way that the level of true innovation is zero and the level of fake innovation is 100%. Mutual fund industry backbone is SIP, systematic investment plan. Eventually they came up with a lot of products: liquid fund, liquid plus, short term debt fund, short floating rate fund, money manager fund, PSU fund, 100% CPCD and whatnot. And a lot of time a voice being raised into the system that there should not be more than 4 to 5 classifications we have in mutual fund. And I completely agree, because if we have more than 4 or 5 classifications, then it is very difficult for an investor to understand exactly what is going on. But having said that, the biggest problem is not the classification. Rather, the biggest problem is that majority of the investors in India do not know the difference between liquid and liquid plus fund. So if I ask about corporate debt fund and the duration fund, then everyone know that I worked in a treasury department for 10 years. And in this 10 years, I handled almost all American banks. And one of the beauty of working in Treasury department is that you always being invited in a lot of conferences. There are 3 ways people go for conferences. One, for drink, and that is a reality. 99% corporate treasurers in India go for conferences for drinks, because they feel that the kind of quality of the drinks they get, they will never get in their homes. So they go for a drink, because majority of the conference is happening in 7 stars. Few people go for, hope you understand, hardly 0.0001% people go for actual knowledge. Actual knowledge. And they criticize the banks in their own conferences. And majority of the time banks do not reply their questions because they know that if they reply they are gone. The same is the case with the mutual funds also. After Yes Bank scandal, I have not seen any resolution of 81, neither I have seen any media house came forward and asked or invite the best minds in India to deliberate on 81 and try and resolve the problem. And I'm damn sure even a lot of investors and even 99% of the people, those who are watching this video themselves do not know the complete understanding of 81. After Yes Bank, another scandal came, and that scandal is Franklin Templeton closure of 6 funds without any advance intimation to investors. At that given point of time, 2 different numbers came in public domain. One was closer to 25,000 crores and one was closer to 28,000 crores. Even till now, it is not clear which one was correct, but in the safer side, let me go for 25,000. That the total AUM, asset under management in these funds, is 25,000 crores. But the biggest problem is not that. The biggest problem has just started. And let me explain this for you. And this is that problem. Before I go for credit risk fund, mutual funds are looking at launching low volatility product, equity as well as hybrid, to give investor alternative in the current market environment. 31st May 2020. Today is 6th June 2020. Mutual funds are looking at launching low volatility product, equity as well as hybrid, to give investor alternative in the current market environment. Guys, in this country, when most of the people do not know the difference between liquid and liquid plus, duration fund, low duration fund, medium duration fund and high end duration fund, corporate bond funds, hybrid funds, arbitrage funds, credit risk fund, mutual fund is launching another fancy thing which is known as low volatility products. But before I complete this, let me go one level back and tell you that by the time this fancy thing come into the market, what is the status of the earlier fancy thing? Credit funds unlisted exposures may rise, and this information is 4th June 2020. High redemption in the credit risk fund could further increase exposure level of such fund in the unlisted debt papers. The scheme in this category have seen their asset side shrink, and this is likely to let a rise in the proportion of the unlisted shares. Industry players say that the fund houses find it challenging to bring down the unlisted exposure in this scheme in line with the regulation norms, as redemption having continued. So according to the data, January 2020, the credit risk fund were having asset under management around 62,000 crores. In February, more or less intact, 62,000 crores. In March, it is 55,380 crores. In April, 32,000 crores, and in May, it is approximately 30,000 crores. The figures for June is not yet known. Now the problem is that the credit risk fund are always taking an exposure on, first of all, what is credit risk fund? The credit risk fund is a fund who is taking an exposure on a credit quality of a company. And majority of the credit risk fund have taken an exposure on those credit qualities where the companies actually went bankrupt. So it was a miscalculated call. But anyways, no one bothered to ask this question in India because people don't have the knowledge. That is simple. Now the question is, if the credit risk fund is taking a call or having higher amount of unlisted exposure, then you understand that what is the implication or negative repercussion of that on investors. And guys, by the way, even after Franklin, there are many AMCs, those who are still running the credit risk fund. Remember this. But the problem is even not that. The problem is that the unlisting norm of the credit risk fund, basically the unlisting exposure, is not more worrisome if I compare this with this. Credit risk fund have continued to see investors exit with the economy slowdown, triggering fear of downgrades and default. The size of the category is now half what it was in January. The asset as at 29th May, asset under management is around 30,000 and as against the beginning of the year around 62,000. This translates to the erosion of nearly 50%. Experts say that the risk aversion may continue if the downgrade risk appetite. Quite a few non-banking financial corporations have been downgraded on a notch or put on the negative rating watch. How many of you really got a chance to look at the portfolio of a credit risk fund? Just look at that and just see how many companies and banks or financial institutions and NBFC they are taking an exposure. Or better is, download the portfolio of 5 AMC who are offering credit risk fund and compare this portfolio one by one. 1, 2, 3, 4, 5. You would get to know something which no media, no video can teach you. I can explain this, but I want you to get this done. You will get a stark reality how mutual fund actually operates in India. Actually operate. On the name of credit risk fund, thousands of crores is at stake because we clearly understand that the biggest problem now mutual fund is facing is the so-called credit risk. In the month of May, Kotak Mahindra Low Duration Fund reported a reduction in the NPV, NAV, net asset value, and when I called the relationship manager, he gave me a bullshit explanation that it is a mark-to-market loss. Because he believes that a person like me believes in his theory of mark-to-market. And Kotak Mahindra Mutual Fund, by the way, was not the only mutual fund. In history, if I go by history, then UTI, Kotak Mahindra and majority of the AMCs reported degrade in their NAVs. And guys, UTI reported a sudden degrade in their NAVs in their treasury plans. Any answerable? Anyone is answerable. Anyone is accountable. Anyone is accountable. And in fact, 2 weeks ago, there was data that got published in the public domain which suggests that the mutual funds transferred the credit risk exposure from listed AMC, from credit risk schemes to another schemes. Which means that once people go for redemption, so they transfer this exposure to other schemes so that they need not to go to bank for money so that they can get it redeemed. So what is the fault of this other investor who not invested in the credit risk fund? And basically, I am going to be taking Kotak Mahindra Bank very seriously, I assure you, because everyone know that what is the knowledge level of Treasury Consulting Group. Credit risk fund unlisted exposure is rising. Credit risk fund asset under management is decreasing and now it is 50%. And more worrisome for me is not that. The more worrisome for me is this, that rather than acknowledging that the arbitrage fund, the hybrid funds and the so-called credit risk fund, who rather than giving the interest, they are taking the principal of the people. The mutual funds in India are launching another fancy product, and this is low volatility product. Now I complete this. ICICI Mutual Fund recently filed an ETF, exchange traded fund, that will track the Nifty Alpha Low 30 index. It is a part of the suite of the smart beta indices. These all are fancy words. Do not go with this. As of 50% of the index portfolio is oriented towards low volatility stock on Nifty, and rest is oriented toward alpha component. It's all fancy. Example, in year to date, Nifty Alpha Low Volatility 30 Index generated a negative return of 14.6%. If I go with the performance, that year to date Nifty generated 22% negative return. Nifty Alpha Low Volatility 30 generated minus 15%, and Nifty 100 Low Volatility generated minus 12%. So when the profit will come? When the profit will come? I know it's a very technical video and I am shooting video only for the class, this time not for the mass, but I know one thing, that in India mutual funds will continue to launch these fancy products. The credit risk which we forecasted earlier also on the YouTube is a big bubble which is building up. Sooner or later mutual funds are either forced to take the money from the bank to pay the redemption for credit risk, or they will transfer these securities to the other schemes as came in the public domain. So others will also pay the price. Alternatively, these fancy products will continue to come, and majority of the people do not know how exactly these fancy products work. This is what we wanted to convey. Remember that if you are an investor in a mutual fund, then you need to have a very strong understanding about the mutual fund. It should not be like that you do not have any understanding and you are simply investing in a mutual fund only because you trust them. Today we are not living in the times that when you invested in a mutual fund and you look that fund after 2 years and you got to know that 10 rupees invested is now around 14. Today we are living in a time when we need to historically look at mutual fund on a monthly note, like we do on a monthly note. Because if we do not track this, then we are bound to lose. Example, those who, I am damn sure there are many who invested in Franklin, they even till now not aware that these 6 credit risk funds are actually defaulted. But Franklin is saying they shut it down. The problem here in India is that the level of knowledge is so poor that people always go with the fancy word. And because of these fancy words, they are bound to lose. This is what I wanted to convey in this video. So guys, be careful before investing in mutual fund. I'm not saying you should not invest in mutual fund. But before investing in mutual fund, look at the portfolio. Try and understand where a portfolio manager is investing. See the returns of last 6 years. See that where exactly is that fund investing. How often the churning in that fund is happening. Or if churning is not happening, then why it is not happening. For what purpose it is not happening. How much cash holding the fund manager is taking and why he is taking cash holding higher. How much is the listed exposure? How much is the unlisted exposure? And more importantly, how much is the AAA component? Don't just go for the paper rating. Just feel that whether this company deserves to be AAA. I'm not quoting one company. You know that one group currently is in mess in India. And they are selling their brands to the other as to pay the debt. Can they be AAA? And if any rating agencies will give them AAA, you know how the ratings are given in India. So be holistic, be realistic. Don't just rely on mutual fund, pay practically. And specifically before you invest in equity mutual fund, remember that a bird in hand is better than bird in bush. One should be comfortable to earn 7.5% in a debt mutual fund rather than earning 25%, which will never come in equity mutual fund via SIP or direct model. This was our video, and before leaving, do not forget that in a discussion box, in a description box of the video on the YouTube, you will see all the links of our Telegram, Instagram, YouTube, Twitter, everything links you will get. More importantly, guys, do not forget that today it is 7th June and 20th of June the app is coming. It's a matter of 2 weeks now. And after 2 weeks, Treasury Consulting would have own app. Have a good time, and you know my mobile number, which is +91 98 99 242 978. Have a good time. At onset, we thank you very much for watching this video. The purpose of the Treasury Consulting Group YouTube channel is to spare a lot of knowledge, and that too practical knowledge in the public domain. We feel that the current education system in majority of the countries of the globe believes in degree, but we believes in knowledge. People often ask what Treasury Consulting does. Treasury Consulting is a Singapore multinational headquartered group wherein we currently have 3 legal entities, which is Singapore, India and Hong Kong. Eventually in this year we are planning a British entity and 2 OBRs, which is Overseas Bank Representative, which one in Germany, one in Greece tentatively. On knowledge front, we do offer a lot of stuff. We are having our fixed income platform www.fixedincome.global, wherein around 62 plus live trading desks are there. And by December 2021, which is approximately 2 years from here, in a phased manner, about 100 plus, which is about 38 more will come. So in another 2 years, around 100 plus desks would be live. We do have around 200 plus training courses covering various topics which are available live on our fixed income platform. Currently we offer in 5 parts, which is functional trainings, forensic trainings, regulatory trainings, information technology trainings and technological trainings. More trainings are coming. Apart from that, we do offer MTM desk, which is mark to market of derivative, consultancy, project implementation, treasury management system, almost everything which we are coming, and more product domains are coming. On a knowledge basis, Treasury Consulting hold our hedge fund academy, which is 182nd platform. We hold our audiobook academy, which is known as audiobook. We are coming up with our OTT platform, which is over the top, which we titled as TRFX. And it would be completely different than we have Amazon and Netflix due respect to both companies. Our investment bank, hedge fund, it is also coming. More importantly, we operate 44 plus WhatsApp groups, and where we cover the books, the magazines, the bank research reports, I would say the GST, the corporate finance, the educational videos, the treasury, derivative, financial markets, synthetic derivative and whatnot. All these 44 WhatsApp group are linked with the thread. So if a member of one group wanted to join another group, he can freely join that group. There is no. We do operate almost daily derivative email. You are welcome to join our group, but once again this group is subject to invitation and we will see your profile, we scrutinize your profile. So it is not for all, it is based upon the people, those who hold good profile. But if you have a fire in you and we see that you wanted to learn something different, we will definitely give you an opportunity to join. More importantly, my mobile numbers, which is +91 98 99 242 978. My alternate number +91 98 18 485 155. Both are in the public domain. They both are on WhatsApp. You are welcome to WhatsApp me at any point of time. Do not forget that we are the only platform when it comes to private placement, and there are so many things we are offering in private placement and many things which we are adding. Overall, Treasury Consulting is currently a Singapore multinational headquartered group, which would soon be London headquartered group, and Singapore would be Southeast Asia headquarter for Treasury Consulting. Our fixed income platform www.fixedincome.global cover a lot of information. We once again thank you very much for watching our videos, and we assure you that our both YouTube channels, which is Foreign Exchange Maverick Thinkers and which is Treasury X, and our TikTok channel would continue to grow. We are expecting around 6,000 plus videos only in 2020 and around 5,000 plus videos next year onwards on YouTube. And God willing, by 2020 December, we would be crossing hell lot of videos. Have a great time, and once again thank you very much. And our ambition of becoming or serving you or giving you a knowledge which books even do not give would continue. Have a great time.